Welcome to this presentation that forms part of the 2012 Self-Managed Super Fund Trustees Update. My name is Mel Holsworth. I'm the Principal of Holsworth Law & Associates. The normal disclaimer that this is general advice only and doesn't take into account the specific circumstances of your fund. You are aware that the laws are ever changing, and so you need to seek specialist timely advice before making any decisions relating to your financial future. This forms the fourth presentation in the nest of presentations relating to contributions, and I'll be covering the contributions in kind area, which is not a usual occurrence in superannuation funds, but I've noted in the last year or so it's become more pronounced. Especially those who are reaching the age of 55. They seem to be stacking up as much as they can into their superannuation fund, and a lot of questions come to me as to what assets can be transferred into the fund. Occasionally also questions are put to me as to what personal assets their superannuation fund could buy from them as a means of getting money out of the fund over to them personally, and they would then use that money. Trustees may be unemployed at the time or going through some financial hardship, and show that the superannuation fund has got they've got some assets, and they're hoping that the superannuation fund might be able to buy those assets to give them the cash. I invite you to look at the other presentations that are also in this nest relating to timing, concessional, non-concessional, payment of expenses, 3% contributions, 30% contributions tax, which is new from the May budget, and also government co-contributions. Let's get straight into contributions in kind, or what sometimes called in specie contributions in the legislation. In 2010, the ATAB brought down a ruling, TR 2010/1, that gives us a lot of guidance in this area as to transferring an asset into a self-managed super fund as a contribution. I'll touch on that, as well as the superannuation fund also buying assets from members. Just be aware that as a precursor to this, there's an assumption that we're talking about assets that can be transferred, or a superannuation fund can buy, which is really only falls into two categories. The first being real business property, and the second are listed securities. So let's get into it. So to transfer an existing asset, an in-specie transfer of an existing asset to a fund will generally amount to a contribution. If the fund pays less than market value of the asset transfer will generally be made, will both be taken up as a contribution and or as a purchase. The transfer of the asset goes into the superannuation fund for the purposes of a contribution, rather than putting cash into the superannuation fund as a contribution. So a fund can purchase an asset or receive it as a contribution, and just remember Section 66 only allows real business property and listed shares. So example, Mel has got some BHP shares and he wants to make a non-concessional contribution, in other words a member contribution, not a deductible contribution, a member contribution, non-concessional contribution to the fund. Instead of cashing them in, depositing the cash into the super fund and the superannuation fund then go and buying shares again, I can make an off-the-market transfer of the shares to the superannuation fund. Now note, it's a little bit of a watch this space. The Tax Commissioner, under the new FOFA regulations that it's bringing out, is looking to make some changes to this. They're not through yet. The devil will be in the detail of the legislation, but at this point in time, and the time of doing this presentation, the legislation isn't out, so we can still continue to do these transfers and do off-the-market transfers of this type. It's important to determine the nature of an asset transfer, because a contribution will not count towards a contribution will count towards a concessional or non-concessional cap, i.e. the employer may make a transfer of an asset to a superannuation fund, or an individual may make a transfer. So if an employer makes it on behalf of one of their employees, then of course it's a non-concessional contribution, or a concessional contribution, whereas if a individual who's not claiming a tax deduction makes a transfer, it's a non-concessional transfer. And both count towards the cap. If the fund has purchased any part of an asset, a deduction cannot be claimed for that purchased portion. So there are different ways a fund can acquire an asset. So let's resume the different ways that a fund can acquire. So if a superannuation fund buys an asset at market value, then it's not considered to be a contribution, it's a purchased asset, and so the money has come out of the superannuation fund as the buyer to the seller, which is either the employer or a member. The asset is transferred to the fund for no consideration, so this is a contribution, and the amount of the contribution is the market value of the asset at the time of transfer. The third example is the fund pays some consideration for the transfer. So the contribution is the market value less the consideration that was paid. Of course, the amount of consideration paid is classified as the purchased amount, and the balance is classified as a contribution. Then the fourth example, an asset is purchased by the fund for less than market value. So the contribution portion of that is the difference between the actual market value and the amount that was purchased being the below market value. The best way to explain the fourth section is, let's just say real business property that was valued at $700,000, was in the name of Mel and Lynn Holsworth, was transferred to the superannuation fund, but it was only valued for the purposes of the transfer at $600,000, though the market value was $750,000. The superannuation fund actually bought it for $600,000 and paid Mel and Lynn Holsworth the $600,000. The other $150,000, i.e. the difference between the purchased amount, which was below market value, and the actual market value of $750,000, that being $150,000, is a contribution. So some things you need to watch. Listed assets are easy to value at the time of the transfer or the purchase. Listed assets, an example would be shares and listed trusts like Westfield Trust and the Bunnings Property Trust, etc. Real business property needs a written valuation, and it's important to receive that, because that's how we gauge as to what is the proper market value of the property. And just be aware, as again, that the government has announced that the transfer of listed securities is being changed. We don't know, the change was supposed to have come through for a 1 July start, but that hasn't come through as yet, and so it's a little bit of a watch this space. Thank you very much.